By the end of this video, you'll know exactly how the IRS taxes your cryptocurrency, and more importantly, how to stay out of trouble. And the last thing I'm going to tell you, it's the one mistake that gets even experienced traders hit with penalties they never saw coming. So sit back, grab a drink, and let's get into it. Here's the thing. Most people think crypto taxes are complicated. They're not. But the IRS has made them confusing on purpose. Once you understand the 3 rules I'm about to share, you'll see it's actually pretty straightforward. Let's start with the foundation. The IRS treats cryptocurrency as property, not currency, not securities. Property. That distinction matters more than anything else in this video. What does that mean for you? It means every time you sell, trade, or use your crypto, you're potentially triggering a taxable event. Let me say that again because most people miss it. Trading one cryptocurrency for another is taxable. Buying a coffee with Bitcoin? Taxable. Buying an NFT with Ethereum? Taxable. The moment you exchange crypto for something else, whether that's dollars, another coin, or a digital artwork, you're looking at a capital gains event. Here's where it gets specific. In 2014, the IRS issued Notice 201421. That was the first time they laid out how crypto taxes work. Then in 2019, they published Reverend Rule 201924. That ruling clarified that hard forks and airdrops count as taxable income too. And last year, in 2023, they dropped Notice 202374. That one addressed blockchain analysis and the cost basis methods you can use. So, here's the first rule. Rule 1. Selling, trading, or spending crypto triggers a taxable event. The gain or loss is calculated the same way it would be for stocks or real estate. You take what you sold it for. You subtract what you paid for it. The difference is your capital gain or loss. Now, the tax rate depends on how long you held it. If you held for less than a year, that's short-term capital gains, taxed at your ordinary income tax rate. Could be 10, 12, 22, 24, 32, 35, or even 37%. If you held for more than a year, that's long-term, and that drops you into the preferential rates. 0% if you're in the lowest brackets, 15% for most middle income earners, 20% for the highest. That difference alone could save you thousands. Let me give you a real example. Say you bought one Bitcoin at $30,000. It climbs to $45,000. You sell it. That's $15,000 gain. If you held it for less than a year and you're in the 24% bracket, you owe $3,600 in taxes. But if you held it for 366 days, just one extra day, and you fall into the 15% bracket, you owe $2,250. That's $1,350 saved just by waiting. Yeah, it adds up fast. All right, that's the foundation. Now, here's where things get more interesting. Rule 2 is the one most people completely overlook. Crypto isn't just subject to capital gains tax. Sometimes it's taxed as ordinary income, and ordinary income rates are higher, much higher. When does this happen? A few specific scenarios. First, getting paid in crypto. Your employer sends you Bitcoin as a salary. That counts as wages. Taxed at ordinary income rates. Second, mining. When you mine new coins, those coins are income the moment they're received. The fair market value on that day is what goes on your tax return. Third, staking rewards. Ethereum proof of stake payouts. Cosmos delegating rewards. Solana staking yields. All of those are taxable income, same as mining. Fourth, projects dropping tokens into your wallet. The IRS says that's taxable income too, fair market value at receipt. And here's one that trips up a lot of people. NFTs. Creating and minting an NFT, not a taxable event. But selling that NFT, that's a capital gain. Or if you receive the NFT as payment for work, that's ordinary income. The IRS is watching NFT markets closely. They issued specific guidance in 2023. Don't assume NFT profits are going unnoticed. One more thing about Rule 2. DeFi protocols. Lending your crypto on Aave or Compound, the interest you earn is taxable income. Liquidity pool rewards, taxable. Even governance token rewards dropped into your wallet unexpectedly. Taxable. The complexity of DeFi doesn't exempt you from taxes. It just makes record keeping harder, not optional. If you're finding this helpful, hit subscribe. I drop videos like this every week, and the last point is the one that could save you the most headache and the most money. All right. This is the one I've been saving for you. Rule 3. Documentation is everything. And most people do it completely wrong. Here's what the IRS expects from you. Form 8,949. That's where you list every single crypto transaction for the year. Every trade, every sale, every crypto for crypto exchange, every NFT purchase or sale. All of it. Then that rolls into Schedule D on your tax return. Now here's the problem. Most exchanges only show you what you bought and sold. They don't track your cost basis across multiple wallets. They don't automatically figure out which specific coins you traded. And they definitely don't flag every taxable event on their platform. Let me give you a real scenario that happens every single April. You bought Bitcoin on Coinbase in 2020. Then you moved it to a hardware wallet. Then you traded it for Ethereum on Uniswap. Then you moved that Ethereum to another exchange. Then you sold it. The IRS has no record of that Bitcoin sitting in your hardware wallet. But you still owe tax on the gain from that original purchase to that final sale. If you can't document your cost basis at every step, the IRS can assume your cost basis is zero. That means the entire sale is treated as profit. Every single dollar. That happened to a trader named Marcus in 2022. He had the records for his Coinbase buys, but he couldn't prove what he'd paid for Ethereum he'd received through a series of DeFi swaps. The IRS audited him. They hit him with a deficiency notice for $47,000 on assets he'd bought and sold within the same year. The penalty alone was $9,400. He eventually won on appeal, but it took 2 years and $15,000 in legal fees, all because he didn't have records. So how do you protect yourself? You need to track every transaction, every wallet, every swap, with timestamps, amounts, and cost basis. There are tools that do this automatically. CoinTracker, Coinly, TaxBit. You connect your wallets and exchanges. They pull in transaction history. They calculate your gains and losses. They generate your Form 8,949. Most of them have free tiers for casual traders and the paid versions. Usually $50 to $150 per year are worth every penny if you're doing any real volume. One more thing, cost basis method matters. You can use FIFO, first in, first out. That means the first coins you bought are the first ones sold. Simple, but not always the best. There's also HIFO, highest in, first out. That sells your most expensive coins first. Often results in the smallest gain. And then there's specific identification. You get to pick exactly which coins you're selling. If you're strategic about it, you can minimize your tax bill significantly. The IRS allows this, but you have to document your selection at the time of sale in writing. Don't skip this step. Now, one last thing, the wash sale rule. This is important. Currently, the wash sale rule does not apply to cryptocurrency. You can sell at a loss and buy back the same asset immediately. The loss is still deductible. That could change. There's been legislation proposed. The IRS has signaled interest in extending the wash sale rule to crypto. But right now, as of this recording, it's not applied. Enjoy it while it lasts. So there you go. 3 rules. Rule 1. Selling, trading, or spending triggers tax. Rule 2. Mining, staking, and income events are taxed as ordinary income. Rule 3. Document everything, or the IRS will assume the worst. If you got value from this, share it with someone who trades crypto. Hit subscribe. I've got something even better coming next week. See you then.